So hello and welcome to Knowledgist. So today we are going to discuss about Bank of Baroda Industrial Credit and Corporate Credit Batch 2020 syllabus, credit management syllabus, and the intro to credit management, basics of credit management with MCQs thereafter. So today is the formal first session. Second session onwards, it will be there in the application. Also, all the students who have enrolled for the batch from tomorrow onwards, they will be getting the quant reasoning English section as per the syllabus. The written batch, written classes link will be shared to their dedicated group. So yes, good evening. Am I clearly audible to all of you? Am I audible to all of you? Just confirm. Yes. Very good evening to everyone. Very good evening to everyone. Yes. Let's start. Just a second. Yes. Uh, just a second. Just a second. So yes. By the time, just 1 second. 1 second. We are starting. There are some technical issues. I'm starting in a second. Just a minute. Just a minute. We are starting it. By the time you can join our course, everything. Okay. 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 Yeah. Yeah. Okay. So yes, just a second. We are having the issue from this slide. Yes. So now I will discuss for a few minutes about the credit management principles of what we are going to cover in this batch is the principles of credit, types of credit facilities, credit rating, analysis of financial statement. The financial management class will be enough for that. Working capital assessment, non-fund based facilities, that is the documentary credit part, both letter of credit and bank guarantee. Then non-fund based facility, export finance, NPA management and IRAC norms, credit risk and credit derivatives, signification of documentation, need and essential features, term loan appraisal. Then the credit manage in the second part, it will be the constitution and credit type. That means the types of borrower, facility wise and product wise documentation, essentiality or essentials of mortgage and surcharge, types of charges, resolution framework, PSL and government sponsored schemes, all types of credit guarantee schemes, DRI loan, government sponsored schemes, IBA norms on education loan, very important, management of impaired asset, that means NPA. Then ratio analysis, cash flow and fund flow statement, source of finance, MSME, agri, credit monitoring, project finance, credit rating, pre-shipment finance and export credit in rupees, pre-shipment credit in foreign currency, running account facility, retail loans and corporate loans, Lok Adalats, debt recovery tribunal, SURFACE, write-off, IBC, CDR. Some other points, guidelines of survey registration, types of decree, factoring, civil and fair practice norms, law and related to bill finance, deferred payment guarantees, law of limitation, Companies Act 2013 and Transfer of Properties Act. General banking, AML, KYC, RBI master circulars, RBI recent amendments, banking regulation, recent development in financial market, banker customer relationship, NI negotiable instruments, government sponsored schemes, and legal banking asset, legal banking terms. And yes, we are going to start the basics of credit management now on. Okay? Yeah. Yeah, it is important for everyone, scale 3, scale 2 people, because we will be covering only basics of credit management. Clear? So, yes. Yeah. Basics. Effectiveness of credit management of banks is key for profitability. Banks measure interest income comes from credit management. Nowadays, after the invention of the third party business, or you can say after the addition of third party business, for some time since last 5 to 10 years, bank is looking towards other ways of profitability. But in a conventional method of banking, bank has only one way to make money, that is to lend to the customer in a higher interest rate than the deposit rates, or in the rate in which they acquire the money. Okay, bank has two business to do: acquiring money from the depositor and lending it to customers for interest income, right? So for years immemorial, the bank's only income was coming from effective credit management. Now, even there are other avenues to earn money, like third party business, like you have the treasury department, which is doing your back office job and doing investment kind of thing, merchant banking roles they are playing. They are generating profit, but still a major chunk of bank's business comes from credit management. Okay, and an effective credit flow leads to a prosperous nation, a prosperous economy. You have seen in last 3 days back, the finance minister calling the heads of RRB, heads of public sector bank, for discussion on for a discussion on for forcing them to do more and more KCC and animal husbandry business. Why so? Because effective loan disbursement by these banks are going to create job and are going to lead the economies to prosper. Clear? So, but when we discuss about effective credit management, three main important points come to our mind, that is safety, liquidity, and profitability. As a credit manager, when you are disbursing loan, or when you will be disbursing loans once you get selected, yes, yes, when you are selected, you have to look, when you disbursing money, you should look into the safety of your money. As bank's money, it is your money essentially. So when you are disbursing or giving a loan to someone, should you get it back when demanded or not? That is the safety of your money. Is the money of bank or the public money, because it is not your money, not bank's money, it is the public money, the public depositors money. Is the depositors money going to come back to you again or not? That is the first point that you should keep in your mind. Is the money safe in the hands of your borrower or not? First point, liquidity. Liquidity means availability of cash when it is demanded or when it is required. Yes, that money with that person is safe. He is going to return you eventually at any cost, right? But what happens if he is not going to pay you in the EMI date? Because according to the EMI, or according to the repayment schedule, you and your asset liability management department prepares the balance sheet of the bank or prepares the interest rate, etc. Right? So the entire ALM will fail if a certain portfolio is not being collected or not being returned to you, or it goes default and you do the settlement at a later date. You will lose liquidity. And once you know that what happens to institutes when they are unable to match their liquidity requirements. Recently, IL&FS and other NBFCs failed due to very weak asset liability management system in place. So liquidity is a major concern. Is this person is having enough money to repay you? Safety, where you find the safety part, is the intent of the customer, right? That means whether the customer is willing to pay you back or not. If he has intention, whether or not he is having all the capabilities to pay, he will borrow from some other sources and repay you if he is having a good intention. But liquidity management will suffer if the customer is not having ability to pay, right? That means if his income is suffering, or you have not calculated the DSCR, debt service coverage ratio, or fixed obligation to income ratio in an unsecured loan case, then having good intention is not sufficient enough for him to repay you your loan in due course of time. So liquidity is the second point that you need to keep in mind. Clear? Third point, profitability. If you are acquiring money at 6%, 7%, your cost of fund, which is in other words called the operation word, is called cost of funds, right? Cost of funds means what is you at what cost you acquire money. In current account, it is zero. In savings account, it is 3.5. In FD and RD account, or in time deposit, in other words, it is 6%, 7%, right? So if you don't disburse all that at a nine loans at least at 9% percentage, you don't earn profitability. So you as a banker is bound to generate profitability for the sake of your depositors, because when you accept money from your depositor, you promise them pay an interest rate, and where you arrange that interest rate, or where you arrange that additional money which you are going to pay them, by generating profit. So it is your moral obligation to generate profit when you are disbursing a loan. Clear? So whether or not it is going to give you adequate profitability or not, it is the third point you discuss. Okay? Clear? Many people are saying some good things about us. Jaya Maheshwari saying thank you for CBO course. BOI credit expected exam date is July last week. That's great. All the best. People are saying thank you for whatever good comments, because we were focusing on class right now. Yeah. So retail lending. Retail lending, credit types. One is retail lending, corporate lending. In Baroda, you will have the corporate lending. In RRBs or in BOI, etc., you are going to do the job of retail lending. Priority sector, it is important for everyone. Off balance sheet exposure, or you can other words say documentary credit, that is LC and BG. Okay. So this is credit management steps. So we have covered all this in intro session. So what you do in pre-sanction, what you do in post-sanction, what is the difference between loans and advances? I have discussed it many a times. Loans are normally term loans, uh, car loan, home loan, etc. Advance are types of loans where it is a running account, CCOD. Clear? So in a loan account, there is one-time disbursement. You sanction and you disburse, and there is a fund flow for one time from the loan account to the savings account of the customer. Okay. But in advance, there are multiple disbursement or multiple cash flows from the loan account to the depositor's account. Clear? So this is the basic difference. Now securities in credit, you can divide loans into two different parts: secured loans and unsecured loans. But there is a definition to that, because in layman's terms, secured loans is a loan where there is a guarantee, third party guarantee or mortgage is there. It is secured loan. When there is no mortgage, it is an unsecured loan. It's as simple as that. But it is defined under section 5 and subsection N of Banking Regulation Act. An unsecured loan is something where the security value is less than 10% of the loan. Okay. Even if there is someone has taken a loan of 1 crore, and the mortgage, the property value that he mortgaged is worth 9,99,000, then it will be treated as an unsecured loan. Clear? Okay. Is it clear up to this point of time? Because as a banker, you need to learn, or as a credit management aspirant, you need to learn the technical terms, the sections involved into it. You just cannot say no guarantor, no mortgage, it's an unsecured loan. Even there is a mortgage and the security value therein is below 10% of the loan value or of the outstanding, it will be treated as an unsecured loan. Clear till this point of time? Yes. Primary security versus collateral. Can anyone tell me what is the basic difference between primary security and collateral? Primary security is something that is created out of the loan amount. Is it clear? So, like you have taken a car loan, and from that the loan disbursement you bought a car. So here the car becomes your primary security. But in what is collateral? Collateral is something which you place or give as a mortgage to get a loan. Like in a land loan or a loan against property, you mortgage your property for getting a loan. So that is called, yes, that is called collateral. But you buy a house by taking a home loan, and here the home becomes your primary security. Yes, primary collateral is the first charge. Yes. So when you are assessing a credit proposal, what is the first point you need to go look into? Safety, or in other words, willingness to pay or intent to pay. First point. Many people say that ability to pay is more important. But remember, intention to pay is more important. And how you check the intention to pay? From civil, from his past transactions and past record, you find whether this person is a willful defaulter or not. Okay, chronic defaulters you avoid. Vijay Mallya was having the ability to pay, but he was not having the intention to pay. So intention to pay is more important. Second is ability to pay. If there is no ability to pay and intention is there, it could be a loan. It will slip to a bad asset, and then you will do settlement. Okay, and and how you check the ability to pay? From the financials of the customer. Financials of the customer means if it's a salaried customer, the salary account statement and the salary slip will suffice the cause. And if it is a corporate account, there you need to check the balance sheet, cash flow statement, profit and loss, future orders, if any the customer is having or not. So all that you need to check. It will be a thorough check. You will have to prepare the CMA report. All that needs to be done, and it will be sufficient enough to tell you about the ability to pay. And ability to pay can be calculated in a corporate loan through the methods of DSCR and by the other means of ratio calculation. DSCR stands for the debt service coverage ratio. Clear? Yeah, assessment of credit needs, terms of sanction, documents, and creation of security interest. We'll see all that. Consumer loan versus retail loans, that you see from our basics of credit management session. Today we'll discuss about uh, uh, today we are going to discuss about securitization. Okay, Lien, etc. Loans and advances against security. Sorry, we will now see different types of charges, and we will first start with Lien. This is very important to know about. Yeah, Lien, various types of charges where lien, mortgage, assignment all comes into picture. What is lien? Under this process, security is created on a financial asset. Asset could be two types: financial asset and non-financial asset, home, car, etc. Non-financial asset, financial asset could be the money left in savings account, current account, the term deposit receipt, the DDs, the bonds are financial assets. So lien can only be processed on a financial asset. The name of the liability holder is marked on the face of the financial instrument as lien. If you are keeping a fixed deposit receipt as lien, so on the face of that document you have to mark as it is under lien to this and this bank. Under this system, the ownership is with the borrower, whereas the possession is with the lender. The security is created only on financial asset. What does that mean? Like you have gone to a bank to take a loan against security, right? So you have pledged your security statement or stock statement, or nowadays through demat you do it. So when you go and give your demat under lien or demat account statement, the stock statement under lien, the particular stock under lien, bank will only take possession of it, but the ownership will always lie with the customer. Like the FDR is marked lien to State Bank of India. So the fixed deposit receipt will lie with the bank. Bank will keep it in their vault. But the ownership, or who is the owner of the fixed deposit, still the customer is the owner. Bank cannot break it and get it. Okay, cannot break it and get the money because owner is the customer. But bankers have the implied pledge. I will come to that later. If the customer don't pay for a longer period of time, Bankers is have bank, only bankers have the capability to break the lien. Okay, others it will be general lien. You cannot break it. Lien means the right of the creditor to retain the goods and securities owned by the debtor until the debt due from him is repaid. It confers upon the creditor the right to retain the debtor's security and not the right to sell it. So if I as an individual take you have taken a loan from me, or you have taken money from me, you have given your fixed deposit receipt, or you have given some money to me, or some articles to me for lien purpose. I can only retain that instrument with me till my money is paid to me. But in between, if I want, I cannot sell it. Clear? But in case of pledge, I can sell it. That is the difference between lien and pledge. But in case of a banker, the lien marked to a bank is equal to a pledge. So that's why the banker's lien is called implied pledge. That means only banker is having that kind of liberty that in case bank's money is not repaid, bank can sell it and get its money back from the customer or from the sale proceeds. Okay, so the lien is of two type: particular lien and general lien. Particular lien, if you have marked lien for some particular event, then the lien will be for that. General lien for any purpose, like you have taken a gold loan. Sorry, you have taken a loan against security loan against your FDR. So your FDR can only be marked lien for that particular loan only. Okay, but in case there is a loan, and there is a loan and you have money in your savings account. Okay, in loan the customer is not repaying and nothing is marked lien. The- in general lien, banker can mark lien their savings account. The savings account money is not pledged to take the loan, but still, as under the provisions of general lien, bank has the permission to keep their money of savings account under lien. Clear? Particular lien, if it is for a particular event, if customer has given the fixed deposit receipt to you for loan number 123, then the amount of the amount due in 123 loan can only be marked lien to that fixed deposit receipt. Okay, so but if if in the loan account there is a due, customer is not paying under the provisions of general lien, you can mark lien of of his money lying in your branch or in any other branch, because you enjoy the provisions of general lien, and at the time implied place you can even deduct the money from his savings account and credit it to the loan account if eventually the customer is not paying to you under the provisions of general lien. Yes, right to set off, you can say it. Right to set off means you have the right to set off the dues of a loan with the money lying in the savings account. Okay, all the doubts of Bank of Baroda, please ask me at the end of the session. Once we discuss the MCQs, then we will discuss. Then banker's lien is a general lien, and it is also called implied place because it enjoys all the characteristics of place. In place, what you do, you have the right to sell the goods that is pledged to you. Clear? Pledge under this process, security is created on both financial asset and physical asset. Your gold loan, in gold loan, you can give gold for pledge. Okay, and you can also give pledge your fixed deposit receipts, etc. Okay, it is defined under section 172 of Indian Contract Act. Pledge is the bailment. Bailment means of movement. Bailment of goods as a security for the payment of a debt or a performance of a promise. So that is the definition of pledge. Okay, hypothecation, it is created on on movable properties, and under section 2 subsection n of securitization and reconstruction of financial assets and enforcement of security interest, that means surface 2002, it is defined. Okay, a charge or upon movable property existing or future created by borrower in favor of secured creditor without delivery of the possession of the movable asset. So in a hypothecation, the asset that is under hypothecation is not, there is no physical movement required. When I buy a car loan, my car is hypothecated to State Bank of India, but State Bank of India will not take possession of my car. That possession will lie with me. My ownership will lie with me. The ownership of car will lie with me. Only the charge will be created in the name of State Bank of India. Clear? Clear? Yes, is it clear? We're discussing a little technical term, but as all of you are professional bankers, I believe that you know a lot more than me, but still I want to refresh some of your thought process. Okay. Then comes to the mortgage. It is say similar to hypothecation. Hypothecation is on movable property. Mortgage is on immovable property. That means on land, etc., where your property cannot be moved. Similarly, the possession is with the customer. The ownership is with the customer. Only charge is created in the name of the bank. Clear? There are six types of mortgage, and whichever is not covered under this above six types of mortgage will be called anomalous mortgage, or the seventh type of mortgage. Equitable mortgage, English mortgage, simple mortgage, usufructuary mortgage, mortgage by deposit of title deed, mortgage by conditional sale. Equitable mortgage means under this mortgage, the borrower deposits the title deed of with a simple letter stating the intention of creating the mortgage. In this type of mortgage, the lender creates the mortgage. The ownership is not transferred to the lender. It is to be only registered under Sarsai portal. Clear? Clear? So title deed, the deed of the property will be deposited to the bank, but ownership and possession both will be with the customer. No transfer of ownership. Only a charge will be created on Sarsai portal. Clear? Is it clear? Any doubt you ask in comment section regarding the concepts we are covering tonight. And at the end, I will be discussing all your Bob related queries. Bob related queries do send us. Yes, it is operational risk if not registered under Sarsai portal, because customer can sell it to anyone if it is not shown in Sarsai portal, or he can mortgage it to somewhere else to take another loan. So that's why it is an operational risk, Gaurav. Clear. Yes. English mortgage needs to be witnessed and signed by the borrower and lender in front of a witness. In the case of English mortgage, the ownership is transferred to the lender, and same is transferred back again after the clearance of the loan. We do equitable mortgage in case of home loan, more equitable mortgage. Okay. English mortgage we generally don't do. English mortgage means when I take a loan from SBI, I will transfer my property documents, property ownership of my property in the name of SBI. When I repay, SBI will return it to me. Nowadays, it is not necessary. Okay. All types of mortgage except equitable mortgage must be registered with the sub registrar of assurances in the local area where the property is situated within a period of 4 months from the mortgage date. Simple mortgage is a type of mortgage borrower needs to sign an agreement stating that he or she unable to pay back the borrowed amount in a specified time duration, then the lender can sell the property to anyone to get his money back. Okay. So in equitable mortgage, it is only charge created. You cannot do anything. Uh, you cannot take another loan. You cannot sell that property because charge is created in Sarsai portal, and when you do any kind of transaction, this charge will be shown. So you cannot freely do anything on it. Okay. And banker has no possession, nothing on the property, but banker can invoke surface if the money is not repaid to them. So in a way, bank is safe. In English mortgage, it is transferred to the name of the bank and again transferred back to you when you repay the loan in full. Then simple mortgage, there is nothing transferred to the name of the bank. But in case you fail to pay the loan amount in a stipulated period of time, that amount will be that loan, sorry, that property, the ownership of the property will be transferred to the name of the bank. Usufructuary mortgage, this kind of mortgage gives a benefit to the lender. Lender has right over the property for the due course of the loan period. He can put property on rent. See, what happens in a usufructuary mortgage? The ownership will be there with the customer, but the possession will be with the lender. So as long as the money is not repaid, the customer, the lender or the bank can lease the property to someone else, rent the property to someone else. They can earn the rent income. Once it is paid, it will be transferred back into the name of the customer. Clear? Mortgage of deposit title deeds. It is self-explanatory, I believe. Okay. Okay, mortgage by types of title deeds. In this mortgage, the mortgage provides their documents of title deed of the immovable property to the mortgager with intent to create security on the same. Uh, which type of mortgage in KCC? It's definitely equitable mortgage. Mortgage by conditional sale. Mortgage by conditional sale is when the mortgage sells the property to the mortgage on the condition that the sale will become absolute if there is a default in the repayment. Also, on the repayment of money, the sale will become void and the mortgage will transfer the property back to the mortgager. Mortgage by conditional sale means first, the property, my property, when I take loan to the SBI, will be sold to, will be given to SBI, and SBI will sign a conditional sale to me. When I repay my money, the sale proceed is completed. That property will be given back to me. If I don't repay, the sale proceed becomes null and void. That means that property will lie forever with State Bank of India. Okay, but remember, properties cannot lie with any bank for forever. Bank can only have properties in their name if they are using it for their own purpose. Bank can buy or sell properties for their own needs, right? But if such properties come to them, someone has borrower has defaulted, and they have not paid it. So the property that goes to the name of the bank needs to be immediately sold, immediately auctioned. Maximum they can hold properties for 7 years if it is not for their own use. Clear? Anomalous mortgage, any mortgage not covered under here. Okay. Also, there are some other two types of mortgage: reverse mortgage, fixed rate mortgage. Reverse mortgage is for senior citizens. Like senior citizens want to take reverse mortgage is a loan, right? You have a property, but you don't have money for your day-to-day transaction. So, a senior citizen after retirement if he created a loan, he will go and give a mortgage to the bank, and if the person will get money or an earning from the bank every month. Upon his death, either his legal heirs and nominees will repay the entire money taken from the bank, or they just do nothing and that property will go back to the bank. Okay, that is called the reverse mortgage. Reverse mortgage, it's for if you need an earning from your property and you don't want to sell it because maybe your children will require it in the future, then what you will do? You will do a reverse mortgage. Without taking a loan, you will give mortgage to the bank, and bank will give you an interest income every month, equated month in a, like you pay EMI when you take loan, but when you do reverse mortgage, bank will give you an EMI or a earning every month to divide to whatever property value will there for 10 years or 20 years. Bank will pay you. Upon the completion of 20 years, if the entire money is not returned to the bank, bank will seize it. Clear? Is it clear now? Gauri Shankar Gauri Shankar is asking what is the reverse mortgage. I think you know it. The answer is saying what is the benefit for the because bank will give the margin income, like 1 crore of property. Bank has given them only 80 lakhs. Bank will recover 1 crore from the customer, or bank will sell the property worth 1 crore in a future date. This is the benefit. When lenders assure, bank do nothing without benefit. Everything the bank is having benefit, and banks are not obliged to do anything for free. Even this Jan Dhan account, anything banks do, they are paid for that. There is a commission income they earn from the government. Banks do nothing for free. Even the zero accounts banks are opening are not for free. When banking is not for charity, it's not for free. Everywhere money is associated. Okay. POI credit officer, July end the exam date. So please prepare marketing officer. When the lender assures the borrower that the rate of interest will remain same throughout the loan period, it is called a fixed rate mortgage. Assignment means transferring any future right, any existing or future right, property or debt by one person to another. The person who assigns the property is called assigner. To whom it is assigned, it is called assignee. And the banking borrower may assign to the banker book dates, money due from government departments, and insurance policies. Only these three things can be assigned, and it is defined under section 38 of Insurance Act. Okay. Yes. So please look into the charts on your board. Many a times asked, Lien, security created on financial asset or physical asset. Now you can see the entire chart. Take a screenshot and remember it. I will side myself. Yes. Remember it. Lien on financial asset, possession is with lender, ownership is with borrower, and defined under Indian Contract Act. Pledge, physical asset, movable, and financial asset. Lender, possession with lender, ownership with borrower. Indian Contract Act. Hypothecation, physical asset, movable physical assets, possession with borrower, ownership is with the borrower. Mortgage, physical immovable assets, possession with borrower, ownership is with borrower, and Transfer of Properties Act 1882 it is defined. Is it clear up to this point of time, everyone? Is it clear to everyone? Yeah, Place and Lien, possession is with the lender. Okay. Next, there are three types of risk in credit business or lending business: credit risk, marketing risk, operational risk. We will discuss in coming days internally. Okay. So you know that exposure framework, large exposure framework, and we'll discuss all that in coming classes. And the same is covered in internal sessions in credit management folder. Please cover it. I will cover in this edition the additional classes, like we have prepared the EWS and RFA, the early warning signals, etc. So that class will take place. Okay. Now let's move to few of the MCQs. Most of you have seen the basic MCQs, but we will cover few of them. These are the basic credit questions, not from the basic class. These are the basic credit questions asked repeatedly. So that's why we put it for your exam point of view, and it is important for all. What will be the extent of CGTMSC guarantee cover available in case of amount default is rupees 40 lakh if it is sanctioned to one women entrepreneur? Yeah, hi everyone watching us from LinkedIn, Facebook, anywhere you are watching us. Please follow us and join us in YouTube, because more classes of ours go live on YouTube, because it is always easy to take classes on YouTube live than taking classes in all platforms simultaneously. So yeah, so no, it is 32 lakhs. It is 80 percentage. So you need to go through our CGTMSC class in detail and understand the calculation. They are asking nowadays calculation and in-depth questions. Scale 3 people very much important for knowing the calculation, and others knowing the limit. So in a way, if you know the limit 80 percentage, you can go to you can calculate it in calculate it to 32 lakhs. Okay. Yeah. Next question on your screens. What is the maximum amount the credit facility that can be covered under CGTMSC guarantee for scheduled commercial banks and RRBs? There are different limits for RRBs and for commercial banks. So please tell us which one is the correct combination for commercial banks and for the RRBs. 1 crore 50 lakhs, 2 crore 50 lakhs, 50 lakhs, 1 crore, 75 lakhs for all. Yes, you answers please. CGTMSC PDF is there in the application. Please find out complete PDF with MCQs are there in the credit management folder in application. If you still don't find, please send me the screenshot of content library. I will tell you where to find it out. Yeah, very good. Many people are saying B as the right answer, so I will go with B as the right answer. Clear? Very good. Next question. For domestic banks, incremental export credit over corresponding date of the preceding year up to dash percentage of ANBC or COBE, whichever is higher and subject to a sanction limit of dash per borrower can be classified under priority sector lending. You know, in priority sector lending, export credit is something which is calculated out of the 8 sectors. Clear? But in export credit, there is a limit to be categorized under PSL. So incremental credit means if last year you have given 100 crores loan and this year if you give 110 crores, then the 10 crore is the incremental credit. So only on the basis of incremental credit, PSL will be categorized, and that incremental credit has a limit to. Percentage is there and a limit to. 1% is 50 crore, 550, 540, 240. Your answers, please. Your answers, please. These are practical level questions. You need to learn nowadays practical questions. Nowhere in internet nowadays, basic practical questions are being taught. No, I know that no one is taking Bank of Baroda credit classes because these are very exclusive classes and in-depth analysis requires to be done before taking any class or before recommending any subject for the session. Yeah. Yes, export credit is 40 crore, but 2% should be the incremental credit. Clear? D is the right answer. Very good. Hypothecation is defined under which act? Very silly question. We discussed it right now. So your answers, please. Your answers, please. Hypothecation is defined under Surface Act. What should be the LEF limit for group of connected entities? Large exposure framework. There is something which is a risk management tool formulated by Reserve Bank of India. Banks are not free to give unlimited loans to any entity for that matter. Okay, so bank can give maximum a certain percentage of their tier one capital to customers, to a group entity, to a single company they can give certain amount, and to a group company or to a connected company, because Adani is having so many, Adani Wilmar, Adani Port, Adani Energy, etc. So they are connected entities. To that entire group you can give 25 percentage loan, and to an individual company of Adani you can give 20 percentage, and with RBI approval that can be 25 percentage maximum, and to the entire companies connected with Adani could be maximum 25, and for that matter all the companies Geo, Reliance, everything connected to Mukesh Ambani can take only 25% of a loan, 25% of tier 1 capital from one bank. Am I clear? This is called large exposure framework. Okay. Vatsal saying interview ka batao kuch, and you are not receiving my call. I keep very busy, very packed, and our interview batches are going on for P and B. Can opt for that and you can join there, because Naresh sir was taking the session today. I am here for BOB. Because we have experts for different things. I don't handle everything in one platform, and it is not humanly possible uh, uh, to handle everything, and it is not recommended to handle everything by one person, because you need expertise of different faculties, different persons exposure. You need to crack these exams. These are specialist officer level exam. You need the exposure, risk exposure to prepare for risk management level questions. I supplement with the preparation, but we have a good number of banking experts are with us. So I take advantage of their knowledge, and you should also take advantage of their knowledge too, because panelists for different banks are different. We need all their expertise under one umbrella. So that's why Knowledgist is famous. So we need all their support. And nowadays we have different assignments, different faculties. We are joined by so many public sector bankers, retired and press bankers, panelists nowadays for content creation. So let's take advantage. There is no hard and fast rule that I will be taking everything on earth, and if I will take everything in on earth, it will not be good for you, for me, for everyone. We need expertise compared to unsecured lending. In the case of secured lending, other things remaining same, the probability of default will be higher, same, lower, or can't say. Your answers, please. We are getting lower as an answer. Single, single, it is not 15%. Earlier it was 15, and for group it was 40. Now it is changed to 20 plus 25. Okay. Yeah, 15 percentage we have discussed recently for UCBs, urban cooperative banks. Yeah, it is lower. What is the maximum land holding criteria for financing under DRI scheme? DRI scheme is the differential rate of interest. It should be within 2.5 acre of land, within 2.5 acre of irrigated land and 5 acre of unirrigated land, 1 acre of irrigated land and 2.5 acre of unirrigated land, 1 acre of irrigated land and 2.5 acre of unirrigated land for SC and STs. Your answers, please. DRI is a differential rate of interest. There is a certain section of society which cannot lend loans in the commercial rate of interest laid by the banks. So that's why Reserve Bank of India has given directives to the banks to give loans to certain section of society below their cost of funds. It is mandated by Reserve Bank of India that you cannot lend loans to any company, anyone on the earth below your cost of funds plus your spread, right? But your spread can be less, but at par with the cost of funds, you cannot lend to anyone except DRI loans. So only in DRI loan you can give loans below your average cost of funds. Clear? Clear. Remember, if you have a very good, your banks, your entire banks board are having very good relation with one company, or by giving him loan with lesser rate of interest, you are getting so much other profits, like so much of deposit, so much of asset management from their side, a merchant banking role, etc., which will generate you huge profit. Even at that condition, you cannot give them loan at par with your cost of funds. Because as I said in the beginning of the session, as a banker, you need to generate profit. It is your moral obligation, or it is a contract which you do with your depositors. Only in DRI you can do it, and DRI loans who can take, it should be 1 acre of irrigated land and 2.5 acres of unirrigated land where the water supply is not there. It's called the unirrigated land. Clear? C is the right answer over here. We need to know things in detail as bankers. Okay? Yes. Are you enjoying the session? Are you all enjoying the session? Is it something useful we are reading and talking today? Loans against the security of shares, debentures, and PSU bonds, if held in physical form, should not exceed the limit of rupees 10 lakhs, 20 lakhs, 5 lakhs, or no such limit. Yes, yes. Very good question, Gaurav. Gaurav is saying that some in some banks, the customers are the staffs are getting 4%, home loans at 4%, or at a concessional rate. So whenever you give a concessional rate of interest loan to your staff, you show it as an expense. If you are working in a private bank, it will be shown on your CTC, and in your balance sheet you will show it as an expense or benefits to the employees. It will be shown as an expense. Clear? Yes, the right answer is 10 lakhs. Okay. Yeah, otherwise 20. If the case of successful auction under SURFACE, what is the maximum time period given to the highest bidder of deposit of the full sale price? 3 months, 30 days, 90 days, 6 months. You need to go through the SURFACE class entirely to understand all these concepts. All these concepts. Yes, very good. You keep on asking questions. Uh, s- it boosts your morale and our morale when we discuss it. Session should always be interactive in my point of view. So it is 3 months. Okay. Security can be created on the liability of the borrower, asset of the borrower, asset of the guarantor. Both B and C is the right answer. Your answers, please. Yes, very silly question. Answer is both B and C, asset of the borrower or asset of the guarantor. In the case of working capital finance, the primary security is the inventory and the receivables of the borrower, personal guarantee of the promoter, inventory and the receivable of the other business entity, or none of the above. In case of unworking capital finance, what should be the primary security? इनमें से किसको प्राइमरी सिक्योरिटी कहा जाएगा जब हम वर्किंग कैपिटल का फाइनेंसिंग करते हैं? बताइए, जल्दी बताइए, पढ़िए, समझिए और बताइए. Your answers, please. Yes, it is inventory and receivables of the borrower. Okay. What will be the collateral security? Same question, just change in the norms of security. It is that there it was primary. And what could be the collateral security? Inventory and receivable, fixed asset, immovable property of the promoter, both B and C. What should be the collateral security? In SURFACE, you give 60 days period, Manpreet, initially. Take the entire SURFACE class. It will not take you hardly for 40 minutes. Everything is there in the application. Please cover it. Yes. So the collateral security here will be fixed asset of the borrower and the immovable property of the promoter, both B and C. That was the A. Sir Bhansi Krishna. A was for the previous answer. It is collateral security. In case of Lien, security is created on physical movable asset, physical immovable asset, financial asset, or on any physical asset. We have discussed it initially. I need your answer and I need right answer from every one of you watching it. Yes, it is on financial asset, guys. It is financial asset we discussed initially. It is financial asset. Clear? Gross working capital means CA minus CL, CA, CL, fixed asset. CA means current asset, CL means current liability. So, what is gross working capital? CA minus CL, CA, CL, fixed asset. Answers, please. Gross working capital means gross working capital will always be the current asset. Clear? The entire current asset. CA minus CL is what? CA minus CL is what? What is called CA minus CL? Net working capital means CA minus CL, CA, CL, fixed asset. Net working capital means, yes, you got the answer here. You got the answer in the immediate next question. You got the answer in the immediate next question. Yes, it is CA minus CL, net working capital. Clear. What is CAM in credit management? CAM का full form क्या होता है इनमें से? Credit appraisal memorandum, credit appraisal mandate, credit assessment memorandum, credit assessment mail. What is the full form of CAM? Basic and silly questions, but we don't talk basic questions in inside classes. But for specialist officer, they nowadays ask very in-depth question. We will go through all that in coming days. Yes. So the right answer over here is credit appraisal memorandum. Okay. Next question. What is the following? Which of the following is part of CAM? Security to be taken for the proposed facility. Facility to be sanctioned for the proposed borrower. Amount of the sanction. Amount to the sanctioned. Amount to the is mentioned twice. Amount to be sanctioned to the borrower. Not to the amount to be sanctioned to the borrower. Clear? Or all of the above? Which of the following instruments or items are mentioned in the CAM? Yes, it is all of the above. Clear. Which of the following is not a type of civil inquiry? Consumer, commercial, retail, both A and B. Which type of civil inquiry we don't do? Which type of civil inquiry we don't do? There is consumer and commercial. There is nothing called retail civil inquiry. Which section of Reserve Bank of India empowers RBI to collect credit information? You collect CIBIL, right? So where you get the right from? Reserve Bank of India's which section of Reserve Bank of India Act? It is RBI Act, not which section of Reserve Bank. Which section of Reserve Bank of India Act gives you power to collect the credit information of the customer? Section 22, 35A, 42, 45A. 22 is about licensing. Okay. So it is 45A. RBI's power to collect, furnish such information to any banking company in accordance with the provisions of 45D. Clear? The ratio used to determine how easily a company can pay interest on its outstanding debts is called interest coverage ratio, current ratio, debt service coverage ratio, or financial ratio for that matter. Which one of the following is the right answer? ISCR, ICR, CR, DSCR, financial ratio. Ratio used to determine how easily a company can pay its interest on its outstanding debts. The right answer over here is interest coverage ratio. It is the formula is EBITDA, earnings before interest, tax, and depreciation divided by the interest expenditure. Clear? The ratio indicates firm's ability to meet its short-term liabilities is called ICR, CR, DSCR or financial ratio. Okay. EBITDA you can say, EBIT you can say because I the additional A for amortization. So EBITDA up to depreciation by interest ratio, by interest expense. Clear till this point of time? So here it is the current ratio. Okay, CA by CL. Ideal is 1.25 to 1. Clear? Maximum amount of loan against the warehouse receipts of farm produce that granted to farmers can be classified under agriculture as per priority sector guidelines other than negotiable warehouse receipts is 10 lakhs, 20 lakhs, 50 lakhs and 1 crore. It's a priority sector lending questions and these are recent amendments. Very good, Manpreet. 50 lakhs. And if it is an ENWR, negotiable warehouse receipt, then or negotiable warehouse receipt, then it is 75 lakhs. If it is not negotiable, then it is 50 lakhs. Clear till this point of time? Clear till this point of time? Hopefully, yes. NWR and ENWR both 75 lakhs. If it is not negotiable, then it is नहीं, increase हो गया sir. Aspirant guide is saying yes, increased for negotiable warehouse receipts. When it is negotiable, in this question we have not told you about negotiability of the warehouse receipt. We spoke about only warehouse receipts. The only warehouse receipts are up to 50 lakhs and negotiable warehouse receipts are of about 75 lakhs. Thank you once again for joining us. You are with Knowledgist. Please follow us on LinkedIn, YouTube, wherever you can. In LinkedIn, we have crossed almost 32,000 followers. So much of love there also. We have recently joined in LinkedIn, but we got an astounding response from students there. Okay. So you can join our dedicated Bank of Baroda Industrial Credit and Corporate Credit course. Course link is there in description, or you can visit knowledgist.in/BOB. There you can find it out. So thank you once again for your love, support, and time. In case any doubts, anything else, please ask me. Aspirant guide is saying wonderful session. Thank you once again for inspiring us. Keep loving us, keep supporting us. Join our exclusive Telegram link. Everything is there under description in description. And for next say, 6 to 7 days, I will be traveling to few locations. Uh, so please send me messages, and whenever I will be free, I will be responding to them. Okay. So thank you for once again for your love and support. Yes, few messages are not yet answered today because I am keeping it quite busy. So definitely I will be answering them in late night today. Anything else, you please ping me. Thank you once again for your